if you're a family and you're looking for like basic necessities to survive the day or the week, and you have silver coins or gold coins, then, and you're going to ask me what am I more likely to get my food with, I would
Silver.
say your silver. Well, from what I saw most recently, is that SLV has been draining for I think 5 straight days. That's not such a big deal in itself, but it's pretty rare when it happens when silver is climbing as fast as it is now. And I guess from the prices, from the spot prices, silver bottomed back in late September, it looks like, and it's been over 2 months from there. About nine. It's been about 9 weeks.
Yeah.
And the supply of silver in SLV has not really gone up much. It hasn't. I mean, it's only been falling the last 5 days, but it should have. It usually goes with the silver price, up with the silver price and down with the silver price. But now it's just it's not going up. Doesn't mean it won't. But it means that right now, at the present time at least, the paper traders, the chasers, the ones that aren't really interested in silver, they're interested in using silver as a vehicle to speculate. They're not really following this rally. It's not in the paper markets, at least not yet. We'll see if it goes into it or bleeds into it or not. They look forward. I mean, they look forward at the monetary situation.
Yeah.
So if they're going up, that means that there's a higher chance there's going to be printing sooner. But you also see it in the bond market. Yeah, it's not the CPI that's going to determine the Fed's actions. It's going to be some kind of crisis developing in some part of the monetary system. Some bank somewhere is going to ask for help, and then the Fed's going to get a bunch of calls the next day from other banks that are being infected by it. You don't know exactly who it's going to be, what it's going to be, but it's going to be something, and it's not going to be the CPI. It's not going to be like the inflation all of a sudden comes way down, and then oh my gosh, we need more price inflation, so they print. That's not what's going to happen.
Yeah.
In terms of what I think about this chart, at times like these, I wish my old teacher Bob Wenzel was still alive, so he could, and I know what he would say. But really, it's impossible to really know, because the movement of the chart, since we're getting into the real parabolic phases of this. I mean, we had a real parabolic growth in money supply in 2020 and 2021, like the system has never seen before. And just looking, if you zoom out, you really see it. It's like it's vertical. So that followed by to be followed by the biggest drop in money supply growth annually ever, and you see that in that little curve downward afterwards that we're undergoing now.
Yeah.
So a huge spike followed by a huge drop. What's going to happen? Eventually, there's going to be a collapse. The question is, how long is that lag? How much money is left in the system from the 2020 printing, and how much longer can it support the current capital structure? We don't know the answer, but it's not going to be that long. How to find a reputable dealer? It's not that hard to find a reputable dealer. I mean, you can deal with Andy Schechman is trustworthy, and he's one of Mario's affiliates. You can also do AppMex. I've ordered from them, no problems. If you want someone more serious and you have more money, you might want to talk to Egon von Greyers. I like him too, and Claudio Grass in Switzerland.
Yeah.
But you'll find someone, and most of them are honest, and you don't want to go on like the secondary market and go like some guy's house on who's selling on eBay or something. I mean, you could buy on eBay, but that's more risky.
Yeah.
Just go with the dealer and make sure that you're spacing it out so that you're comfortable with your purchases and you're not overextending yourself. And you can sleep without worrying about what the price is going to be a week, a month, or 6 months from now. It doesn't really matter. Just put some of your liquidity away every month, and at the end of a few months, you'll have a good amount. That's all.
Yeah.
Just by the nature of the market, they're not going to react as quickly because companies have their inventory. It's going to last for a while, and they don't constantly shift prices every day depending on the spot price. They have, you know, a business model, and they have to keep it, and they have accounting, and so they shift their prices every so often, which is why when you see suddenly if silver just like collapses like it did in March 2020 to like $11, the premiums will skyrocket. It doesn't mean that the premiums are bigger. It just means that they haven't adjusted their prices yet to reflect the spot prices. Maybe they can't even do that. Well, we see in basically the economy is more of in a fever than they hoped for. They were hoping for a slowdown in wages, so that would, you know, they believe in this like cycle. You more wages, more higher prices leads to higher wages, lead to higher prices, and that's true on the surface. And if it's happening now when the money supply is falling, that just means that the lag in the labor market and the consumer prices is it's not really reflecting the money supply shrinkage yet. But that's because these markets are at the end of the structure of production, so they get affected last. But if the Fed keeps raising interest rates and the money supply keeps falling as a result, then you're going to have more unemployment, you're going to have lower wages. It's going to happen. But then before any of that can actually be triggered, you're going to have a banking crisis, because that happens first before any other stuff happens. So before the labor market is going to have a chance to react negatively to the money supply falling, the banks are going to suffer first, and that's going to be the most obvious. And the Fed's going to have to pivot before anything even happens to the consumer market. I don't know how much I trust these numbers.
Yeah.
I mean, towards the beginning, from 1919, let's say, to, you know, mid 1923, I guess they're more or less accurate, but I don't even know that. I mean, because like, how are these tabulated? Are these talking about exchanges, or, you know, big paper markets, international markets? Or are they talking about like if you go into a store and you offer coins, how much you can get for them? I mean, once you have a hyperinflation like this, the numbers are pretty meaningless. And if you're a family and you're looking for like basic necessities to survive the day or the week, and you have silver coins or gold coins, and you're going to ask me, what am I more likely to get my food with? Silver. I would say your silver. I don't care what the exchange rates are, or how many zeros are after this, or how many zeros are. No, you're going to want silver, because you can't go in with a gold coin and get things that, you know, are practical. It's too expensive. So forget about these numbers, especially when you get to the trillions in here. Like, how do you measure this? It's all academic nonsense.
Yeah, I think the way they got these numbers maybe is through the dollar and sterling exchange rate against the Reichsmark, because
it's indirect math. It's indirect math they get from these tables. It's not like they interviewed people in 1923 and said, how did you get your stuff? How did you survive the day? It's not like real research. It's tabulations of tables.
Yeah.